Hi everyone, Mike Riley with Gaining Altitude Financial, and today I'd like to talk to you about the power of rebalancing within your investment portfolio. I have a very good friend who's a successful investment advisor, and one of his tips is that investments are like a bar of soap. The more you touch them, the smaller they grow. So this isn't particularly aimed at people who are day trading because you're only interested in how the market's moving on that particular day on those investments. This is really more for people that are investing for the long term, 5 years, 10 years, 20 years down the road. And trying to follow trends and buy and sell within your portfolio statistically demonstrates that it is less effective than actually working in a managed portfolio. Now, I'm sure there are many that disagree with me, but that's certainly what the research shows. And one of the reasons why that is the case is because of the power of rebalancing within a managed portfolio. And what that means is, of the holdings that are in that particular portfolio, the professional managers that are actually doing the trading behind the scenes will periodically rebalance. They'll shift from an area that has done particularly well, sell those holdings, and buy back into the areas that are perhaps undervalued in order to put the portfolio back in balance. And one of the advantages that this has is it takes the emotion out of it. You as the investor aren't trying to time the market to try and figure out when the best time to rebalance is. So what does that look like? Well, on this hypothetical portfolio, I have put 5 different segments of what you might have in your investment portfolio. You might have some Canadian equities, some international equities, some U.S. equities, some bonds, and some other fixed income instruments. The particular percentages between them don't really matter, but if I was quickly to look at this, I'd say this looks like a typical balanced portfolio. Now, at any given period, whether it's a year or 6 months or even a quarter, some of the holdings within these particular wedges will outperform the other. So if markets are particularly volatile, you may have better returns within the bond or fixed income and less in the equity side. Or during a time of large growth, you might have greater growth in these and less in the other. But let's say that over a period of time, we find that Canadian equities have done particularly well, and they've grown in a greater percentage in reflection to the other. Perhaps the international equity has collapsed a little bit. Maybe the U.S. equity has actually done well, and it now has a greater percentage compared to the fixed income or bond. So now the portfolio might be out of balance, whereas it was supposed to be 60% equity and 40% fixed income. Maybe now it's 70 to 75% equity and only 25 to 30% fixed income. Is that a big problem? Not necessarily, but the longer this goes on, the more out of skew that particular portfolio can grow, and it eventually will no longer meet its expectations, especially if you're trying to keep it within a certain risk tolerance paradigm. So what happens is that periodically, and you can preset this within your managed portfolio, they'll sell off some of that those Canadian equities, realize a profit within your holding, and purchase maybe a little bit of international equity, maybe a little bit of fixed income that may now be underpriced compared to what you had before, to try and bring that portfolio back into alignment again. The same with the U.S. They'll sell off some of those U.S. equity holdings at a profit, reinvest the dividends inside your portfolio, and maybe pick up some bonds that have been undervalued in order to get it back to that 60-40 mix, or whatever the percentages are within your portfolio. Each one is unique. The reason that is important is because generally when we try and get, like I said, time the market, emotion comes into it. Maybe I'm going to hang on a little longer. Maybe I don't believe what the experts are saying. And statistically, the evidence shows that that type of performance does not provide the kind of reward that a managed portfolio with regular rebalancing can provide. So hopefully that's a little bit of information that you find valuable. If you'd like to talk to me about what a managed portfolio could look like in your financial plan, I'd love to have that conversation. And of course, any other financial planning topics, I'm happy to have. It's Mike Riley with Gaining Altitude Financial, helping you gain altitude and gain confidence.